So, you're thinking about stopping payments on your credit card. Maybe it's the responsible thing to do with so many bills to pay, or maybe you're just sick of being nickel and dimed by your credit card company. Well, whatever the reason, you should know exactly what happens when you stop making payments on your credit card because it can be very different than what you think. So, let me break this down month by month for you. Alright, so let's say you have a credit card with a balance of $5,000 and a 20% interest rate. And every single month you decide not to make any payments on the card at all. Let's start off with month 1. Nothing happens in month 1. You don't make a payment, and the credit card company doesn't do anything about it. They won't call you, they won't email you, and they won't send you a letter. All they'll do is add the outstanding balance to your overall limit and then report it to the credit bureaus. This means that your credit score will go down because your credit utilization ratio will increase. The higher the credit utilization ratio, the higher the risk lenders see themselves taking on by lending you money, and therefore the lower your credit score will be. After month 1, you might start receiving some marketing offers from other credit card companies trying to get you to open another credit card with them. In addition to that, you might also receive a promotional offer from your current credit card company offering you a balance transfer or a lower introductory rate. These offers are designed to get you to open another account with them, or at least get you to start spending money on the account again, so they can start earning money back from you. But you should not take these offers, because it will only add to your overall debt. Now, after month 2, things are going to start getting serious. Month 2 is when most credit card companies start charging you a late fee if you haven't made a payment yet. This late fee is usually around $38, but it can be much more depending on the bank. Now, on top of this, they'll also start charging you a penalty APR. This is an increased interest rate that is much higher than your normal interest rate. It's usually around 29%, but it can be much more depending on the bank. And this penalty APR will stay on your account for anywhere between 6 months and a year. So, as you can see, month 2 is when things start getting really expensive. Now, after month 3, things are going to start getting even more serious. Month 3 is when most credit card companies start calling you to try and collect on the debt. And these calls could come in at any hour of the day. So you could be woken up by a debt collector, or you could be at work or at dinner and get a call. And it can be pretty aggressive. So, as you can see, the constant stress and anxiety of getting these phone calls can be pretty tough to deal with. After month 4, your credit card company might take you to court and get a judgment against you. What this means is that the court has ruled that you do in fact owe them the money, and they can start taking money from your paycheck or bank account to pay off the debt. After this point, your credit card company will report the debt to the major credit bureaus as being delinquent. And the funny thing is that this delinquency will stay on your credit reports for up to 7 years. And after month 5, things are going to start getting very ugly. After month 5, your credit card company can start wage garnishment. What this means is that they can take a portion of your paycheck to pay off the debt. And depending on how much you make, they can take anywhere from 10% to 25% of your paycheck. On top of that, they may also place a lien on your home if you own one. This means that they are putting a claim on your property to ensure that they get paid back. And if you ever sell the house, they will have to be paid back before you get any of the money. Now, after month 6, things are going to start getting very painful. After month 6, your credit card company can start property liens. What this means is that they can put a lien on your bank account, your car, or any other property that you have. And if you ever try to sell that property, they will have to be paid back first. Now, after month 7, things are going to start getting pretty desperate. After month 7, your credit card company can start taking money from your tax refund. What this means is that if you file a tax return, they will take the money that you are owed and apply it towards your debt. Now, after month 8, things are going to start getting really painful. After month 8, your credit card company can start taking money from your retirement accounts. What this means is that they can take money from your 401k or IRA to pay off the debt. And this is a really bad thing because you really shouldn't be tapping into your retirement funds unless you absolutely have to. Now, after month 9, things are going to start getting pretty scary. After month 9, your credit card company can start putting a negative item on your credit report. What this means is that they will put a negative mark on your credit report that will stay there for 7 years. And this can make it really hard to get approved for new credit or even get a job. After month 10, things are going to start getting pretty rough. After month 10, your credit card company can start suing you. And this is really bad because they can take you to court and get a judgment against you. And after that, they can start garnishing your wages or placing liens on your property. Now, after month 11, things are going to start getting pretty bad. After month 11, your credit card company can start shutting off your utilities. What this means is that they can turn off your water, your electricity, or your gas. And this can make it really hard to live in your home. And finally, after month 12, things are going to start getting really ugly. After month 12, your credit card company can start foreclosing on your home. What this means is that they can take your house and sell it to recover the debt. And this is really bad because you will lose your home and have to start over. Now, there are ways to stop this process from happening to you. The first thing you can do is call your credit card company and ask for a lower interest rate or a lower minimum payment. Most credit card companies are willing to work with you if you ask nicely. Another thing you can do is transfer the balance to a credit card with a lower interest rate. If you have good credit, you should be able to find a credit card with an interest rate of around 15 to 20%, and this will save you a lot of money in interest payments. You can also look into balance transfer offers from websites like Credit Karma or Card Match. Another thing you can do is get a personal loan to pay off the credit card. Personal loans usually have lower interest rates than credit cards, so this can save you a lot of money. You can also consolidate the debt with a debt consolidation loan or work with a credit counseling agency to negotiate with your credit card company on your behalf. As you can see, stopping payments on your credit card can have serious consequences, so it's important to make at least the minimum payments on time to avoid these consequences. In addition to that, it's also important to have a plan to pay off the debt as soon as possible. You can do this by creating a budget, cutting expenses, and increasing income. By following these tips, you can get rid of credit card debt and improve your financial situation. If you enjoyed this video, I'd appreciate if you followed, subscribe, and turned on notifications.